Welcome back to the Japan FinTech Observer. Get ready for a quick hit of the latest news in Japanese finance and fintech. We're diving into the headlines, breaking down the trends, and leaving you with the insights you need to stay ahead of the curve. Let's go.
Today, we are dissecting a critical move by the Japanese regulators. The Financial Services Agency's working group on the crypto asset system held its fifth meeting, concluding months of intense discussions by proposing a major overhaul of how crypto assets are regulated in Japan. This shift marks a significant acknowledgement that crypto assets are no longer just a payment curiosity, they are a bona fide, albeit high-risk, investment product. Let's dive into the core findings and proposals that will reshape the Japanese crypto landscape. First, the context: why the overhaul? The primary driver for this regulatory push is a dramatic change in market behavior. Data presented by the FSA paints a clear picture. Crypto is an investment vehicle for the masses. Japanese crypto asset exchange accounts now exceed 12 million, with deposits topping 5 trillion yen. That's a market size that has eclipsed traditional FX trading in Japan. Crucially, this is not just an institutional or wealthy phenomenon. Most new investors are ordinary individuals. 70% earn below 7 million yen annually, and over 80% hold less than 100,000 yen in their accounts. Their motivation? Long-term capital gains, not just payments. But with opportunity comes significant risk. The FSA is fielding over 350 complaints a month related to crypto, primarily concerning outright fraud and solicitation scams. The FSA's stance on the resulting regulatory proposals is clear and deliberate. This review is not an endorsement. The goal is simply to ensure that if these high-risk assets are being traded, they are traded on a fair and functional playing field, especially for vulnerable retail investors. Second, the core proposal, a shift to FIA. The most fundamental change proposed is migrating the regulatory authority for crypto assets from the Payment Services Act, PSA, which governs crypto as a means of payment, to the Financial Instruments and Exchange Act, FIEA, which regulates investment products. This strategic move leverages FIEA's robust mechanisms for investor protection and market integrity, including stringent rules on insider trading, fair disclosure, and administrative enforcement. To avoid regulatory overlap, the working group suggests removing crypto asset regulations entirely from the older PSA and consolidating all rules under the FIEA, tailored specifically for crypto. But what about the digital asset ecosystem beyond Bitcoin and standard tokens? Stablecoins will remain under the PSA framework, acknowledging their primary function as a settlement tool. NFTs, however, will remain outside the FIEA's scope for now. The diversity and use cases of NFTs are too varied to subject them to a blanket financial regulation without further study. Third, information disclosure and market integrity. Protecting investors in a market characterized by technical complexity and information asymmetry is paramount. The proposals focus on forcing both issuers and exchanges to provide clear, timely, and truthful information. Information disclosure. New sales, primary and secondary fundraising. Issuers raising capital, whether through new tokens or by selling already issued tokens from their treasury, must provide comprehensive disclosures. These disclosures must be readily understandable for retail investors, covering everything from underlying technology and supply schedules to the identity of centralized management teams and the use of raised funds. Role of exchanges. Exchanges will become the gatekeepers. They must scrutinize new assets before listing and present the required information clearly. Critically, if a centralized asset is found to be guerrilla listed, meaning the issuer is secretly raising funds without participating in the listing process, the exchange must be mandated to refuse the transaction. Continuous disclosure. Timely disclosure of significant events is mandatory. While the working group deemed annual periodic disclosure less crucial than for traditional stocks, it is still recommended for issuers to provide annual updates to supplement the timely information flow. Enforcement and integrity. The FIEA provides the muscle here. The working group proposes strict penalties, establishing harsh penalties and civil liability for false or incomplete disclosure, mirroring FIEA rules. External audits, mandating that exchanges commission code audits by specialized third parties for new listings. Insider trading. Japan will implement comprehensive insider trading rules for crypto assets based on the FIEA model. This covers not only major corporate events but also large-scale transactions and material information related to the operations of the exchanges themselves. The penalty system will include administrative monetary penalties, or surcharges, enforced by the powerful Securities and Exchange Surveillance Commission, SESC. Fourth, addressing business risk and cybersecurity. The operational aspects of the crypto market are equally scrutinized, with a focus on mitigating the high risk of asset loss due to hacking. Client asset protection. Recognizing that even highly secure cold wallets are not immune to sophisticated attacks, exchanges will be required to maintain an appropriate level of liability reserves, or compensation funds, to cover potential losses. The use of insurance alongside cash reserves will be permitted to help manage the financial burden on firms. Cybersecurity and third-party risk. The regulations explicitly address the security risks posed by third-party vendors, like wallet software providers, that are part of the crypto asset supply chain. The FSA will demand stronger security standards across the entire industry. Crucially, they propose adding statutory requirements for vendors supplying critical systems to exchanges, subjecting them to a degree of oversight and allowing the FSA to intervene directly if security is compromised. Unregistered and fraudulent activity. To combat the rampant fraudulent use of crypto, tougher rules on unregistered firms, criminal penalties and administrative enforcement powers will be substantially strengthened against unregistered foreign and domestic entities. Cooling-off periods. Exchanges must implement mandatory cooling-off periods for new accounts or suspicious transactions involving transfers to external, unhosted wallets, acting as a mandatory speed bump against fraudulent schemes. Fifth, the challenge of balance. Despite the clear direction, the working group meeting ended with a significant debate about the practical implications of these stringent rules. As noted by some members, the reality for the industry is complex. Many domestic crypto firms are currently operating at a loss. Imposing a heavy compliance and self-regulatory burden, with costs estimated to be significant, could lead to mass consolidation or the closure of domestic exchanges. This raises the key concern. If Japan becomes too difficult or costly to operate in, will innovation simply migrate overseas, leaving domestic users with fewer, possibly more restricted choices and access to foreign platforms or unregulated DEXs? The FSA acknowledged this tension, recognizing the need for the self-regulatory organization, SRO, to rapidly professionalize and for the government to ensure the compliance timeline allows for a practical transition. However, the fundamental regulatory philosophy, prioritizing investor protection and market integrity over unfettered, potentially unstable innovation, is now firmly established. The transition toward a stable, FIEA-regulated crypto market in Japan is underway, but the path ahead remains challenging, requiring careful execution to avoid stifling the potential of digital finance. That concludes our analysis of the Financial System Council's proposals. Join us next time on the Japan FinTech Observer as we continue to track these developments.